Hello everyone, I'm Marty Pospischil and welcome to my January 2023 market update. Happy New Year everyone. Okay, grab my clicker and let's jump right into this. We've got lots to cover today. As many of you know who are repeat viewers, the metric I use to measure how active our market is called the sales ratio. And all the sales ratio is the absorption rate of product into the market every month. So how much of the product in the inventory is selling every month, and it's the price balance, it's the sales ratio balance that determines price fluctuations. So, for example, if less than 11% is sold in a given month, we are technically in a buyer's market. It's favoring the buyers, there's downward pressure on pricing, and buyers are having a heyday out there in the market. If the sales ratio or the inventory absorption rate is between 12 and 20%, we're in what we call a balanced market. It's not favoring the buyers or the sellers. But if the sales ratio jumps above 21% of the product selling on a monthly basis, we are technically in a seller's market. There's upward pressure on pricing, we're getting bidding wars, etc. So that's the metric that I use, and you'll see that as I go through the various products and areas. Now, let's look at my monthly table. We're seeing that prices are continuing to soften and volume is down. We're getting less sales, of course, than we normally would be expecting. If we're looking at detached houses first, the sales activity year over year is down 53%. 53% less sales in detached houses in Greater Vancouver. The benchmark price from this time last year is down 5.1%. And the price drop in the last month, most importantly, is down 1.8% on detached houses, Greater Vancouver. Let's look at attached townhomes and duplexes. The sales activity is down year over year, 48%. And the benchmark price, first time it's dropped from the annual year over year basis for attached townhomes, 0.2% drop in price and 1.5% month over month. And if we look at apartment condos, activity is down 52%. Prices are still about 1.7% higher from this time last year, and we're down just under 1% in our pricing from last month. So no surprises there. What's hot and what's not? Again, remember our sales ratio break between 12 and 20 is balanced. Anything over 21 is a seller's market. Less than 11, we're in a buyer's market. So, firstly, let's look at detached houses, Vancouver West Side. There's our history over the past several months. Last month, we had a 9% sales ratio for houses on the west side. This month, we're at 10%. So we had a slight jump in sales ratio. In activity, not price, but in activity. You'll see that in a number of product. So basically what that means is the houses that were for sale on the west side were actually selling at a little bit faster rate than they were the month prior. If we look, and so we're still in a buyer's market there for the west side. If we look at now our condos and townhomes, Vancouver West Side, there's our history. You can see we had some pretty active months last year for attached product on the west side, and this past month we are at 20%. So still pretty active, but we are technically in that balanced market range. And if we look at condos, townhomes downtown, I separate that area out. There's our history over the previous months. We are this month at 17%, so well in that balanced market range for condos, townhomes downtown. Now, if we jump into the east side, detached houses, we can see last month we were at 13%. This month we're actually at 14%. Again, slight jump in activity. The inventory that was there in houses in the east side were actually selling 10% faster than they were the month before. And that's a balanced market territory. And of course, condos, townhomes, Vancouver East Side. Last month we were at 21%, and this month I believe we have no change. Yes, we're at 21% sales ratio, which of course is seller's market. Interestingly enough, for condos, townhomes on the east side, our most active product area. Okay, sales ratios generally for Greater Vancouver, townhomes, condos, detached. You can see how they traveled from our peak back in spring down through that balanced market territory and dipping into the buyer's market range as our year begins. And what's happening in the burbs? Interestingly enough, same trend. The inventory that was there last month, even though the month was slow, picked up slightly in most of the suburbs, with the exception of North Van, Burnaby, New Westminster, and Tsawwassen, where we had a drop in sales ratio. That was detached, attached, same trend. The sales ratios, slight uptick, slight blip in all the activity, except for Coquitlam, Ladner, and South Surrey, where the activity dropped. Okay, if we look across BC in the entire province, we can see home sales are down. That's a fact that we know. New listings are down. Now that's something I'm going to stress, because that is the main factor continuing with our market, is our inventory is limited. There's not enough to buy, and that's a dramatic impactor on what's happening with prices. Housing starts, we are starting to see some builders starting to build across BC, interestingly enough. Remember the sales to active ratio, same as the sales ratio. You can see that across BC we had that drop since spring, and we're now in that balanced market territory in the province as well. And if we look at the volume of sales, of course that's down, and you saw that in our year-over-year stats in BC. So what's happening with prices? If we look at our average price graph since 1977, you can see that peak in houses back here, and we've got that little bit of turbulence here coming to where we are today. Same with townhomes, same with condos, and you can see that dramatic activity we had since 2002, making the rest of this graph look flat. But that's what's happening right now. An average MLS residential price across BC is, of course, down. Overall, we're down across BC in all product types and all neighborhoods since that spring peak of last year. So what's going to happen in our market? Well, the big factor here, as has been the case for the last 8 months, is inflation. And the Bank of Canada, of course, has tightened its fiscal policy in order to get inflation down to their target rate, which is around 2 to 3%. We haven't been there for some time. And our next big announcement date from the Bank of Canada will be January 25th to see if indeed they do increase the overnight rate. And from this article that just came out in the Globe, it looks like they're alluding to inflation not going to where it needs to be yet, and that there might indeed be another rate increase on that January 25th announcement. So that's quite interesting. If we look at the main drivers, again, what's controlling our market? There's really market enhancers in green and market deterrents in red. The big enhancer, as I mentioned already, is the low inventory levels. And it's the one driver left that's keeping the prices from falling more rapidly. When the inventory starts to increase, which we're seeing signs of now, our phones are ringing, we're listing properties starting to come on for January. We're starting to see that inventory start to increase. So I think this is beginning to change. Of course, consumer confidence, I brought that from red back to orange for the sole reason that people are actually now moving forward on their real estate activities. Buyers are starting to buy if the inventory increases. Sellers are starting to put their homes in the market. People are downsizing. People are having kids. They need more space. There's only so many months people will put that on hold until they say, hey, this is now our market, this is a reality, let's accept that and let's move on. And that's starting to happen, and you see that in the consumer confidence is starting to come back, although people are still concerned about the economy, inflation, the interest rates, all of these things that are happening. Is part of a big market driver. And of course, inflation is the big market deterrent. Being as high as it is now, the government's, of course, tightening its fiscal policy, as I mentioned, raising that overnight rate, which directly impacts our lending rates, and that is cooling the market down, and that's having a direct impact on our mortgage rates. Okay, so those are the market deterrents and enhancers. Consumer confidence, as I noted, is down. That's the general sentiment now we're seeing in Greater Vancouver and BC and across Canada. The unemployment rate, interestingly enough, it's been pretty low. The Canadian unemployment rate's at 5.1%. Just jumped. I just checked it online, and it's jumped up to 5.2 just now. And the BC rate is at 4.4. Still fairly low. When we see those change dramatically, that's when that recessionary discussion will start to resume. But the unemployment rate is still pretty low. Again, Tiff Macklem holding the market in his hands. More needs to be done to get inflation under control. Inflation remains too high, and interest rates need to keep rising, was the Bank of Canada's statement. So it looks like we're preparing for an announcement of January 25th of a slight increase. Hard to say what that will be, but that of course will impact the lending rates and impact the buyers and the market again. Okay, so current inflation rate, we are right now at 6.8%. Here's the band we want to be in, between 2 and 3%. Ideally, here's where we are. You can see we're significantly higher over the last 18 months compared to where we have been over many, many years. And that's why that overnight rate keeps bumping up to keep inflation down, trying to get it down. The cost of borrowing, as you can see, has jumped up dramatically. And people are hitting their trigger rates in their variable rate mortgages. And of course, the Superintendent of Financial Institutions in Canada has been asked to ease off, at least in that stress test, but they're not. So you still need to qualify at 2% higher than the posted rates. And of course, we're waiting for that January 25th announcement on what's going to happen with the overnight rate, which will indeed impact it. And Jay Powell, from the chair of the U.S. Central Bank, said that they promised to slow the pace of the rate increases, but they're still keeping the door open for some more, again, to get that inflation back down. So here's a table I just put together, which is really neat. The Bank of Canada overnight rate increases over the past year, 7 back-to-back rate increases last year. We can see back in March we had 0.25%, bringing that overnight rate to 0.5%. In April, another 0.5%, jumping to 1. In June, we jumped to 1.5. In July to 2.5. In September to 3.25. In October to 3.75. And our last rate increase of 0.5 point, 50 basis points, in December 7th came to 4.25, and our overnight rate, incredible fiscal tightening, unprecedented from what I can see in history in Canada, again, to get that inflation back in check. So January 25th, the next date that we're watching for. When might the rates come back to normal? There's a couple of models. The financial market expects that to start happening again in the beginning of 2024. We're going to start to see those rates come down. The model of the Bank of Canada is predicting is very similar, but we're probably not going to see those mortgage rates start to change dramatically until the end of this year and beginning of next year is what the models are saying. So difficult to say exactly, but that's a bit of a forecast. Inventory levels. Now again, our one market enhancer, what's happening there? If we look at the lower mainland, that's the gray line, it's staying pretty steady and dropping slightly. We can see inventory in other areas climbing dramatically. On the west side, if we look at houses, you can see last month, the previous month, we were at 564 houses. We dropped to 403. That's not untypical for December. It's pretty typical. We get that lower inventory. And again, if the buying pace rate remains the same, that in itself, with the lower inventory, same pace of buying, will bring up that sales ratio. That's why we saw that uptick of sales ratios. throughout the Lower Mainland and in Vancouver because the inventory has dropped, but the demand was still there. So that caused that sales ratio to jump up. And if we look at attached for the west side of Vancouver, again, big drop last month in inventory. And again, that's why we saw that uptick in sales ratio. So we're going to get back more into regular data at the end of this month. So it'll be interesting to see what happens in January. So what's next for prices? If you look across BC, you can see we've had that softening take place in the Lower Mainland, and that's pretty typical. We're seeing throughout BC in all the various areas. And the volume of sales, as you know, we're way down from where we should be, and that's predominantly due to the fact there's just not enough product in the market to turn over, and I think that's just starting to change. Market conditions, you can see again, if we're looking at the sales ratio across BC, we're well into that balanced market, and in some product categories jumping into the buyer's market. The house price index, again, looking at all those different areas, pretty well dropping throughout. If we look at the main factors that I'm following, you can see that we've had that peak in the housing price index for Vancouver back in spring, where the prices increased up to that and have been falling since. And the main determining factors for that have been, of course, the interest rate increases, the consumer confidence. Now they've introduced the BC cooling off periods, so that 3-day home buyer rescissionary period is now in place. And the federal ban on foreign home buyers is also now in place, and those are going to have some impact negatively on the activity in our market as well. Economic uncertainty, recessionary discussions, etc. And the one thing that is yet to change is that inventory, and that's next on the block to impact our market. So it's hard to say how quickly it will continue to drop, but those are the things that we're watching and in our market. So basically, if we look at the forecast, here's sort of what I'm keeping an eye on. The inflation seems to be peaking. It does seem to be easing off a little bit, and that's good news. So it's not continuing to increase as we were seeing last summer. That's really important. January 25th, again, an integral date in the Bank of Canada making that fiscal policy announcement, whether they're going to increase the overnight rate or not. That will affect lending rates and will again impact the market. They say there's about a 3 to 4 month lag of how it impacts the market, how it impacts inflation following the increases. So we're seeing today that inflation sort of tapering slightly from the changes that were made to the overnight rate 3 to 4 months ago. So that's interesting. So they're kind of forecasting a little bit and seeing, okay, when do we need to stop with those increases? So that will be interesting to see what they do on January 25th. The Fed, again, as I mentioned earlier, is promising to ease off on raising the rates, but they're keeping the door open for continued fiscal policy tightening well into this year. And of course, that has an impact on Canada as well. 2023 looks like it's going to be a difficult year for many Canadians. Inflation certainly isn't helping. The cost of everything has gone way up. You're seeing it, I'm seeing it, whatever we're buying, from groceries to gas to just materials for renovations. All of these things are very expensive, and it's difficult for people who are sort of living paycheck to paycheck when that increase takes place. So we're seeing that this year is going to be difficult for a lot of people, and the government's hope is that's going to curb spending and bring that inflation back down so we can get back into a normal economy, and that's what they're trying to do. So we've reached a point now, though, in our market, because there's been so little activity over the last 8 months, that people are saying, hey, it's time now for us to buy that place. It's time now for us to downsize from our larger home, even though the market's a little less active than where it was 8 months ago. And people are starting to move the market again. We're seeing that. Buyers are buying, sellers are calling us to list their property. So we're starting to see that activity start to increase, which will, of course, feed into the next few months. So in conclusion, mortgage rates will remain high through 2023. We're not going to see much change in that until maybe fall. That's interesting, and that will impact our market and continue things as they are. Prices are currently falling, as you saw on my table, between 1 and 2%, depending on the product, depending on the neighborhood, but on average 1 to 2%. And the activity in the market will now begin to come back. So you're going to start to see some sales taking place. You're going to start to see more listings. You're going to start to see more sales. And, if that trend continues, because of the factors that we're looking at, we could see another 10 up to 24% price drops still this year. So that's very possible. That's my update on all the stats. I love keeping you informed. And if you haven't popped onto our YouTube page, I recommend you do and subscribe, because we've got lots of fireside chats on things like trigger rates and interest rates and pre-approval process. All of that's really interesting to watch. Also, if you're into more of the podcasts, pop onto all of our podcast sites on Apple Podcasts, Spotify, or Google Podcasts. We've got lots of podcasts you can listen to while driving or in the gym or whatever you're doing to keep you informed in the real estate market. And, fun fact, yes. Have you, the lighter side of my update, have you ever gone into the store to purchase laundry detergent? And it's in the same aisle as all the fabric softeners. And, I'm going to be 60 this year, so I have trouble. I pick these up and I'm trying to read which ones are detergent, which ones are fabric softeners, and it drives me absolutely mad because they've got the actual product type in really small print, and I can't find it until I really study it. It usually takes me a bit of time, and it's really frustrating. So why is that? What's going on? Why don't they put a big detergent on these bottles so I can see what I'm buying? Well, the point is, the bottom line is the manufacturers want you to remember the brand name, not the product. And it's all about brand loyalty and name recognition. They don't want you just going in there and buying detergent. They want you to buy their brand. Now, why is that? Isn't there any government regulations controlling these labels? So people like me will have less time in the detergent aisle finding the detergent or fabric softener or whatever I'm sent to go buy? Well, there is. It turns out that under the Competition Bureau of Canada, there is a labeling guideline. Now, interestingly enough, when you read it, the labeling guideline says that the product name, meaning detergent or fabric softener, must be at least 1.6 millimeters in height. Now, not 1.6 centimeters, 1.6 millimeters. Who can read that? It's absolutely insane. And if the surface area of the label is less than 10 centimeters squared, it actually drops to 0.8 millimeters. I would need my glasses on to find that. Just an interesting fun fact. It is legislated. So there's me in the detergent aisle. Thought I'd throw that in because it's always bugged me. That's my market update. Again, if you'd like to watch these videos and updates, go to our YouTube page. We're on Facebook and on Instagram. If you're into the audio podcast, we're on Apple Podcasts, we're on Spotify and Google Podcasts. I encourage you to go watch those. We're getting a lot of positive feedback from all of those posts. And Happy New Year. Thanks for joining me. I'm Marty Pospischil. Have a great year, everyone, and I'll see you all in a month.